All right, let's get right into it. Today, we're unpacking a story that is literally redefining the intersection of big tech, high finance, and global geopolitics. I mean, what actually happens when a massive standard corporate acquisition suddenly becomes a geopolitical battlefield casualty overnight? Well, we are breaking down the unprecedented unwinding of Meta's massive deal for the AI startup Manus. And look, this isn't just your standard story about a failed merger. It is a real-time look at how the rules of global tech and capital are being completely rewritten right before our eyes. So buckle up because the stakes here could not be higher. To really grasp the Manus situation, we first have to ask this one overarching question. Who is going to control the future of AI? And this isn't some theoretical late-night dorm room debate anymore. It's an active, multi-billion-dollar struggle between the US and China for total dominance over artificial intelligence. So as we go through this explainer today, keep this question in the back of your mind. Every single corporate move, every regulatory roadblock, every dollar spent in the story, it all traces right back to this massive global power struggle. Okay, let's dive into this. $2 billion. That's the staggering acquisition price Meta announced back in December 2025 for Manus, which is a Chinese-founded agentic AI startup. And remember, Manus had pretty much captured the entire tech world's attention with that viral demo showing off their incredibly capable AI agents. Meta saw that, and naturally, they wanted in. They made a huge bet to bring that top-tier talent and tech under their own umbrella. At the time, it was poised to be a landmark exit, a huge win, showing that global AI innovation could actually cross borders. But get ready for some serious financial whiplash, because here we are at $1 billion. This is the amount the co-founders of Manus are now, just a few short months later, scrambling to raise from outside investors. Why? Literally to buy their own company back, to reclaim their startup from Meta. That $2 billion dream exit? Effectively shattered by regulators. And now, these founders are forced to launch an unprecedented billion-dollar rebound strategy just to keep their enterprise alive. To fully appreciate how fast this unraveled, we need to look at the timeline. In mid-2025, anticipating their global ambitions, Manus actually proactively relocates its staff to Singapore. Fast forward to December 2025, and Meta announces the buyout. But then, by early 2026, boom, the deal hits a brick wall as Beijing regulators start their intense scrutiny. Which brings us to June 2026, where Meta is officially forced to unwind the entire deal following a national security divestiture order from Beijing. So in less than a year, we went from a strategic relocation to a historic buyout straight into a complete regulatory shutdown. And this brilliantly illustrates the stark reality of what's happening on the ground. On the left, you've got Meta's initial plan, deep integration. They wanted to merge Manus's cutting-edge agentic AI seamlessly into the entire Meta ecosystem. But on the right, you see the reality after Beijing's demand, complete operational separation. Guys, this isn't just a pause deal. This is an active dismantling. Meta is legally compelled to go in, rip out all the plumbing they just installed, and completely sever ties they spent months carefully building. Let's look at the concrete steps of this separation protocol because it's pretty intense. According to the reporting, Meta is taking immediate action to cut Manus off entirely. They are actively blocking Manus from all of Meta's internal systems. They're telling their own employees, hey, you can't use Manus tools for internal projects anymore. And crucially, they are halting all data sharing between the two companies. It is a full-blown corporate divorce executed at lightning speed just to comply with this divestiture order. But nestled right in the middle of all this chaos is a genuinely surprising fact. Despite their parent company being forced into this massive, messy divorce, Manus is still actively operating. They haven't missed a beat. They're continuing to ship new features, and they're rolling out major integrations with big platforms like SimilarWeb and Shopify. It really highlights the incredible resilience of this startup. The underlying tech keeps moving forward, even when the boardroom is literally being taken apart piece by piece. Let's move to and see how this builds into the next phase, because the Manus leadership isn't just throwing in the towel. They've formulated a highly ambitious three-step rebound strategy. Step 1, like we mentioned, is raising that $1 billion in outside capital. Step 2 is using those exact funds to form a new Chinese joint venture structure. And Step 3, taking that newly structured entity and eventually listing it publicly in Hong Kong. I mean, talk about a pivot, from a massive US acquisition straight to an Asian public market debut. Now, the logic behind this Hong Kong listing strategy is actually super sound. Manus is basically looking to follow the exact IPO path already blazed by other major Chinese AI startups, specifically companies like Minimax and Zippo. Hong Kong has seen an absolute surge in AI listings this year. By pivoting toward a Hong Kong IPO, the Manus founders are tapping into a proven, currently booming market for AI capital, one that conveniently inherently complies with Beijing's regulatory preferences. Of course, in any deal of this magnitude, you always have to follow the money. So what happens to the investors? Well, it's actually split geographically. The California-based venture firm Benchmark, they actually already got their proceeds from the initial acquisition. They got paid out. Meanwhile, the Asian backers, and we're talking massive players here like Tencent, HSG, and GenFund, they've indicated they are fully cooperating with the unwinding process. So they are actively navigating the incredibly complex reality of reversing a massive financial transaction. All right, let's zoom out a bit. Because the Manus deal wasn't just a target for Chinese regulators, it faced intense scrutiny across the Pacific. See, Manus originally stemmed from a Chinese parent company called Butterfly Effect, and that origin story, it acted as a massive lightning rod for political friction in both Washington and Beijing. This whole situation perfectly illustrates how AI is simply no longer viewed as just software. Both global superpowers view it as critical national security infrastructure. To really understand the geopolitical climate here, let's look neutrally at what both sides were actually saying. Over in the US, politicians were actively raising alarms way before the unwinding even began. As we see from US Senator John Cornyn, there are direct, pointed questions about whether American capital should flow to a Chinese-linked firm at all. From the American legislative perspective, there is this deep, fundamental concern about funding and integrating foreign-linked tech into the broader US ecosystem. Conversely, let's look at the stated position of the Chinese regulators, the ones who ultimately blocked the transaction. Beijing cited three very specific legal insecurity justifications: potential violations of technology export controls, breaches of foreign investment rules, and overarching national security grounds. So just as U.S. lawmakers were sweating about foreign integration, Chinese authorities were equally concerned about their domestic tech and top-tier talent getting absorbed by an American giant. And this brings us to a much larger macroeconomic story. The forced divestiture of Manus by Meta, it's not an isolated incident. It is a single data point in a much broader, much more significant trend. Beijing's sweeping regulatory walls. China is systematically tightening its grip on its entire artificial intelligence sector. They are making it abundantly clear, beyond a shadow of a doubt, that they intend to manage and monitor exactly who gets access to their premier AI talent and intellectual property. Now, what's really interesting about this slide is exactly how sweeping these new restrictions actually are. It's way more than just stopping corporate mergers. Private firm researchers and executives now face expanded travel restrictions. They literally require government approval just to go abroad. And for top AI firms, we're talking heavy hitters like Moonshot AI, StepFun, and even ByteDance. They now require explicit government sign-off before accepting any U.S. investment. It's a total lockdown on both human capital and foreign funding within the Chinese AI space. So the crucial point is this: physical location no longer guarantees regulatory freedom. Remember earlier when we noted that Manus relocated its staff to Singapore back in 2025? They almost certainly did that to appear as a neutral, global entity. But Beijing's actions here prove they are determined to retain control over strategically sensitive technology, completely regardless of offshore incorporation. Having a Singapore mailing address did not protect Manus from a Beijing divestiture order. Which leaves us with this final, incredibly vital question. If both US and Chinese regulators are actively raising these massive regulatory walls, blocking capital, restricting talent, and completely unwinding billion-dollar deals, what actually happens to global AI innovation? Are we entering an era of entirely splintered, localized AI ecosystems? The unwinding of Manus proves the rules of the game have fundamentally changed. Thanks for joining me to explore this complex web today. It's a situation we are all going to need to watch closely, because how this question gets answered is going to shape the technology of tomorrow. Keep learning, and I'll see you on the next explainer.